Good morning or good afternoon, everyone, depending on where you are joining us from, and welcome to today's webinar. My name is Rachel Starbuck from the Business Review, and I will be your host. It is our pleasure to have UMS Group with us today, who will be discussing aligning your asset management investment decisions to your strategy. Today's guest speakers are Jan Schipper and Larissa Malewski. I'd like to welcome you to our new webinar platform. You'll notice that this webinar is browser-based, so if you disconnect, please click the link that you received via email to rejoin. In order to ask questions, you can send them in via the Q&A widget at the bottom of your screen or use the questions box at the top left-hand corner of your screen. We will allocate around 10 to 15 minutes at the end of the session to address any questions or thoughts that you may have. If you click on the green resource list widget, there are a few PDFs and videos to view or download from our speakers. We also have a short survey for you to fill out. This can be found in the red survey widget, and it will also be available at the end of the webinar. Please use the webinar if you require. Please use the help widget if you require any assistance. So without further ado, please allow me to welcome Jan.
Yes, thank you, Rachel. Welcome all to this webinar of UMS Group. My name is Jan Schipper. I'm the Managing Director of UMS Group Europe, and I will take care of the first part of this 1-hour webinar, giving you a presentation as an introduction to the solution that we offer for aligning your asset management investment decisions to your strategy. I will take about 15 minutes. After that, my colleague Larissa Malewski will take over, and she will give a live demo of our web tool. In between, to make this a little bit more interactive, we will ask you a few questions, and I will ask Rachel to help me to set up a poll in which you can give some answers. Well, let us start quickly, first by introducing a little bit more about UMS Group. For those who don't know, UMS Group is an international management consulting firm specialized in solutions for the global energy and utility industry. And we were founded in 1989, so this year we have a celebration. It exists 25 years. UMS Group works around the world, meaning we have offices in the United States, close to New York, in the Netherlands, in Europe, and in Asia Pacific, in Sydney to be precise. Further, we have a business intelligence center on the Philippines in Manila to support our benchmark products. Besides consultancy services, UMS Group facilitates the market with all kinds of client solutions. And one of these solutions is our SOS tool suite, which we will demo today. Further, we do a lot of learning consortia, or in other words, benchmarking. And as said, we have a business center in Manila, which is our answer on big data. Let me start by asking you a first question before I dive into the slides. And Rachel, maybe you can help me here with setting up the poll question. So my first question to you all would be, what would be your biggest challenge in aligning your asset management investment decision in your strategy? Rachel, can you take over from here?
Yes, of course. So the answers are from the following. So this is A, answering detailed questions from management. B, evaluating investments consistently. C, making sure you are addressing all critical risks. D, making sure the investment mix is truly optimal. E, effectively communicating the final investment selections, or F, other. Please select any of the answers. You can select more than one, and please click submit. So are there any results you are thinking you might get from this poll question, Jan?
Well, to be honest, what I would expect is some kind a mix of answers, because we have implemented this solution over 45 times around the world, and these answers were typically the questions where our customers were struggling with. Can I already go to the results, or are you still waiting for some of the results, Rachel?
No, you can go to the next slide now.
Ah, okay. Oh, that's interesting. So I can see from this group that the key question is making sure that the investment mix is truly optimal, which is interesting. So I hope later on in the demo that you can see that we might have an interesting solution, but I'm not completely surprised. I will continue now here, Rachel, with the presentation. So probably you recognize this struggle in your company as an asset manager. So I would guess that most of the people who join this webinar are working in the domain of asset management, and you would recognize this struggle with competing priorities from your board and from stakeholders. And if you recognize this problem, hopefully we can offer you something today which might help. And as an asset manager, one of your things that you really would like to prove to your board probably is that you want to present your investment plan every year based on a very consistent progress with very rigorous numbers where you're sure this is the best I can give you. And even more, it would be very nice if you could tell to everybody, okay, this is the way how you should fund the projects, and this mix between operational and capital spend is the best you can get. Wouldn't that be a nice process if you can facilitate something like that and present it to the board? The reality of life is that with all these changing requirements of stakeholders and all these competing priorities, for an asset manager it always means in the end you get lesser budget and you have to deliver more output. Or, in other words, your playing field gets smaller and smaller, and you have to deal with it. So your overall spend gets less, you have to deliver more. And this pressure on the decision-making process in asset management has caused many problems. For example, in the late 90s in the UK markets, it led to major incidents in the rail industry. And in fact, what is happening is that due to this pressure at strategic level in your company, you get a disconnect between, let's say, the things where you worry about on a strategic level and the things that you have to select in your activity list, what you're going to do tomorrow. More maintenance, more replacements, and there seems to be a disconnect between the thinking at board level and at strategic level and the day-to-day activities that you have to select. And as an answer to fix this disconnect, in the early 2000s in the UK market, they have introduced a guideline for good practice asset management called the PAS 55. And this guideline for good practice asset management has been reviewed in early 2008 and upgraded. And recently, beginning of this year, it has been an input for the international standard of ISO 55000, which all has in the heart this same issue and which it tries to fix, being the disconnect between asset strategy, strategic thinking, and the things that you select on a day-to-day basis. And the recurring principle in the PAS 55 and in the ISO 55000 and in the heart of good practice asset management is this principle of creating a line of sight, or in other words, alignment, or getting back, establishing connections again. And it is all about strategic planning at an organizational level, translating this into asset policies, translating asset policies into asset management strategies, setting asset management objectives, and deriving from that asset management plans for the long term, the midterm, and in the end for your budget next year. So what are the activities you're going to do at the existing assets or at new assets? And if you have this connection between this strategic thinking back to operational activities, then you talk about line of sight. And in our point of view as UMS Group, the real essence of line of sight means that you have to have, on one hand, an understanding of what are the business risks that are associated to having an asset base. So I have assets, I have them for a longer period. What are the huge threats that are involved with having assets? Because all assets have their problems and have their threats on my business goals. So do I have an understanding of these threats? And if I make my decisions so my decision risks on a day-to-day business, and I have my portfolio of activities and I select this is what I'm going to do and this is what I'm not going to do, can I make a clear connection between these day-to-day decisions and these business risks? If you have this connection, then we would, from a point of view of UMS Group, say that you have established a line of sight in your asset management. And we have tried to build a solution that helps you creating this line of sight. Going one step more in detail, if you look at the heart of ISO 55000 and PAS 55, what they in fact are talking about is, first, do you have an understanding of these business risks, those threats that you don't want to happen? And if you have an overview of these threats that you don't want to happen, did you mitigate them with asset strategies and plans? And is there a connection between the business risks and the mitigating plans, the asset strategies? And did you translate these asset strategies into midterm plans and into activities in your portfolio for next year? And if you have so, is your portfolio well connected to the original business risks? Because if you would select a project or if you would defer a project in your portfolio, it would have an immediate effect on your risk position. And from our perspective, you have created a line of sight if you have these connections between business risks, asset strategy and portfolio, as in the triangle in this picture. So let me ask you a second question, because business risks is an interesting thing. What would be your biggest challenge with setting up and maintaining a prioritized risk register? So Rachel, I need your help again to set up this poll. So my question would be, what's the biggest challenge with setting up and maintaining prioritized business risks in your risk register? Can you take over from here, Rachel?
Okay, so if you can select one of the following answers, they are from A, resistance against even more bureaucracy, B, culture change to collect such information, e.g. I am important when I know more than you, C, consistency of inputting the information, D, staffing and or competence to analyze or maintain the information, E, discoverability of high risks that were not addressed, or F, non-applicable. We already have a solid process for this. Please submit one of your answers. Is there anything you think the results might be for this, Jan?
Well, it can be very different, but what I at least would expect if you come in the domain of risks, that for determining risks you need a lot of information, and that's always an issue, so the consisting of the information you need. So I would expect a high score on that element. And look, I've won. If I look at the results, I can see a scattered picture, but it is clearly that you give back that consistent information is really the biggest challenge. But I'm also somewhat surprised that some companies give back that, well, we already have a solid process. Probably that has to do with the fact that most of the companies do need to have a corporate risk management process, and they would see corporate risk and business risk as the same. But I hope to tell you more about why corporate risk and business risk, not per definition, is the same. But let me continue with explaining a bit more. So going back to this connection between business risks and the portfolio of projects. What you want to have is a clear connection, and at a certain moment when you look at your portfolio, you have this list of programs, and there comes a moment, which is your decision risk moment, where you take the decision whether you are going to do a project, you fund it, or whether you are going to defer a project. And what is really important is that you need to have an understanding of each of these projects, what the business case is, so what is the positive strategic added value that each of these investments create. That's when you fund it. Or when you don't fund it and you defer a project to a next moment, what is the risk of deferral? And why is this so important? Because both when you select a project, but also when you defer the project, it will have an impact on your overall risk position in your risk register. And that's why you need to have this understanding of as well the business case, but also what does it mean when I defer a project. And if you can establish this process, it would be a very strong and nice thing to have, because then you would have established a line of sight in your decision making. And we would call such a line of sight in your decision making a new process, which is called risk-based asset management process. And it would work like this. So most of you already have a workflow system with many work orders, and they are derived from your portfolio at asset management. So you have an overview of programs, and these programs are detailed out in work orders. Having a risk-based asset management process means that all these programs are connected to one or more business risks. Because then you would have a line of sight between risks and programs in your portfolio. But business risks are only risks when it are threats that impact your strategic objectives. So you need to have a connection to your strategic objectives. And as I started, strategic objectives can be very competing in priorities, because there are many stakeholders, and each stakeholder has its own needs and its own requirements. And if you can have a process in place which understands the stakeholder needs, and you can balance the strategic objectives, connect them to your business risks, and connect business risks to your portfolio, then you can talk about a risk-based asset management process. You can even go further. If you would have something in your portfolio that is not connected, you easily can defer it, because it would not have an impact on risks nor on adding value, adding strategic value. In the end, you can define a role model against these processes, but this webinar is not about organizational design. This webinar is about a solution that we have built. So as UMS Group, we looked at this risk-based asset management process, and we have derived a IT solution to support this. And the process where we are talking about consists of strategic planning, risk management, investment planning, and investment strategy selection. And we have built a solution which consists of these four modules. It starts with the strategic alignment module, which balances the strategic objectives that you use in the risk register, where you set and capture all your risks and prioritize these. Then we have a library of projects which you score on value, but which you also score on risk of deferral. And in the end, we have an investment optimization module where you can run and test several scenarios to find the best mix of projects for your portfolio. This is the solution that we have designed based on this risk-based asset management process. And now I want to hand over this presentation to Larissa. Larissa will take care of a full web demo of the tool suite that we have. Larissa, can you take over from here?
Yes, thank you, Jan. So we're going to just jump into our web demo right now. What you're looking at is the navigation menu for our Spend Optimization Suite application, or SOS. The SOS is a decision support application specifically designed to drive effective decision-making across the risk management, investment planning, and investment optimization processes. We understand and fully recognize that your business is constantly changing, your strategy is constantly changing, and therefore we've tried to design an application that is really as flexible and configurable as possible. Your company administrator can have complete access to all the configuration options offered within the application. There are many different ways to configure the application, ranging from adding questions, deleting questions, changing question text throughout the whole application, activating sections, deactivating sections, etc. So that this application can really grow as your asset management team and process grows. Something else I'd like to point out, the application is multilingual. You can enter up to 3 different languages if you have a company that spans either multiple countries or multiple languages. And in addition, as we kind of step through the application, you will see that we've tried to make the screens as streamlined and intuitive as possible, which will help to kind of reduce your training efforts required when you introduce the application to your business. So to actually step into the modules, we'll be going through 4 different modules today, and we'll start out with the Strategic Alignment, or SA module. This is really the starting point for the application. This is where you'll be defining your company strategy at potentially 2 different levels, a top level, which we call the strategic objective level, and then a drill down level that we call the success criteria level. And it is really across these 2 levels of strategy that you'll be making all of your asset management decisions throughout the subsequent processes. So all of the strategic elements that you define within the RIO or risk management module, as well as the investment definition and scoring and investment optimization module, will all tie back to the strategy that you've defined at these 2 levels within the SA module. Likewise, if you see these triangular formations, this allows you to set the relative priority of the various strategic elements that you've defined. And we use what we call AHP, or Analytical Hierarchy Process. It's a force pairs comparison process, which allows you to basically break down complex decision-making into a series of one-on-one comparisons for the purpose of deriving the relative importance of each of those strategic elements, so that there's a definite way to define, which element of strategy is more important in a given year than another in terms of closing any kind of performance gaps that might be facing your company at that particular time. Likewise, within the SA module, you're able to assign what we call configurable scoring pages, which are predefined or pre-designed scoring approaches that are used within our investment definition and scoring module. And you'll be assigning each of those particular scoring pages to a particular dimension of your strategy at the success criteria level. And this is the way that the investments in the IDS module will be scored according to either kind of a qualitative approach or a quantitative approach. That is essentially the SA module. We'll now be moving on to the RIO module, or Risk Identification and Opportunities module. This module facilitates the risk management process, and we follow a top-down, bottom-up approach to risk management, and therefore the module is actually split into 2 distinct sections. The first being issue identification, management, and analysis, and the second being risk and opportunity identification, management, and analysis. In terms of the issue section, what we're specifically looking at here is any kind of asset-specific or business-specific issue that has already occurred and may need to be prevented going forward. So we'll jump into one of the screens here. Before we do that, just to kind of point out the general structure, again, we've tried to make the screens as simplistic and intuitive as possible. We start out with, potentially entering something new from scratch. So you'll see here new issue or new risk or opportunity. Being able to go in and kind of manage something that's already been started or entered. You go into the manage issues. And then in terms of analyzing the data that's been entered, we have a whole analysis section consisting of quite a few standard reports and charting outputs in order for you to allow you to better analyze and prioritize the data. I'm going to jump right into something that's already been created or started. So as you can see, this is one screen of the issue section. So again, we're trying to capture something that's already occurred on the system, and we're going to analyze that and see if that's potentially a threat going forward and might need to be escalated to the risk management stage or risk assessment stage for further analysis to see if it might need to be eventually escalated to the solution planning phase for mitigation. So this screen, as all of the screens are, is completely configurable. This first section is essentially just designed to capture any kind of demographic information about the issue name, location, what does it relate to on the system, an asset main component, subcomponent, etc. Then we can get into an assessment section, and this assessment, again, it can either be tied to that top level of strategy that we call the strategic objective level or the sub-level or success criteria level. In this case, as you can see, it's fairly high level. This is tied to the strategic objective level, and we can set up higher level scoring to kind of assess the relative importance of that particular issue or the relative threat of that particular issue. There's also various approval stages that can be activated, as well as issue mitigation and tracking. Now to jump into the risk phase. So if we've entered issues and analyzed them, and then we're able to sort through them and prioritize them to determine which of them we might need to analyze in further detail. So if I jump into the risk and opportunity section, this allows us to take a closer look at any of those potential business threats, and it's more of a top-down view of what in the future could potentially impact our company and be a threat to our company that might need to then be resolved via an investment solution. So if I jump into, again, a risk, you'll see that the structure of the form is very similar to issues. Again, it's completely configurable. Generally, because this is a more detailed phase of analysis, we would ask some more detailed questions, and the scoring would be more detailed as well. As we mentioned, this is not just for risk, but also for potential opportunities, so you can enter according to either. When we get into the assessment phase, again, we're taking kind of a more detailed approach at analyzing that particular risk or opportunity, and we're able to enter information according to both the probability and consequence of occurrence, according to a single time frame or multiple time frames, and also in terms of the most likely case or worst case scenario. So if I jump into the actual scoring, we can set up, these are just examples, but specific consequences and probabilities for a particular risk according to that dimension of strategy. And as you can see, there are various time frames that can be assessed. If you click on all time frames, you can see how a risk might potentially escalate if it's not mitigated in the near term. So if I then move on to the next piece, I can scroll down after I've scored through all of the particular elements of strategy that this particular risk impacted, and then I can see the scoring summary. And I can see across all of the dimensions a maximum risk score across the time frames, as well as a weighted risk score, and those weightings are applied based on those relative weightings assigned in the strategic alignment module. And I can use those scores to help prioritize those risks and determine which need to be mitigated in the near term by potential solutions identified in the next module of the application. In addition to the scoring section, we can also see the risk mitigation. And again, this is when we tie a particular risk to an investment or solution within our IDS module, and after that investment has been optimized or funded, we can determine how much of that risk has potentially been mitigated by one or multiple investments. And you can see in this example, this risk has not yet been fully mitigated. It was linked to 3 different investments, 2 of which were fully funded and 1 was not yet funded. So there's still an element of that risk that is still outstanding and that needs to be mitigated. So again, this allows us to have that constant tracking and line of sight between the various modules of the application. For both issues and risks, we have kind of a full set, as I said, of standard reports and charts. You can see there's various charts that can be opened and exported. In addition, there are kind of a full set of charts that can be analyzed. You can see kind of risk across various time frames, across the various levels, how much of the risk have been mitigated by various investments or solutions that have been presented, as well as kind of a risk matrix to see where you might have high-risk areas. And I can turn off the various time frames so that then I can just concentrate on maybe the very near-term risk that might be problematic and need to be, again, escalated to that solution planning phase. So let's move into the next module. This, again, is the IDS module, or Investment Definition and Scoring module. This is where we'll actually be entering potential solutions or investments. We'll be capturing cost information, demographic information, as well as scoring information across all of those dimensions of strategy, again, defined within the essay module. So again, you can see We've tried to keep this as streamlined and consistent as possible for the entry of a particular investment. It follows the same pattern as RIO. I'm going to jump right into the managed investments just so that we can see an investment that's already been started. So this is an investment that's already been scored. If you were to enter an investment from scratch, you would start out with the investment description section. And this is where we capture the various demographic and cost information about an investment. The first step is potentially linking that investment to one or more risks, again, for mitigation of those risks identified within the RIO module. When we move on to step 1, we get into unique demographic information. This is information that can be captured at what we call the companion investment or work order level. So if you have various work orders or pieces of the investment that you want to track separately for, most often it's kind of financial accounting purposes, say you have a distribution investment with an IT component, this allows you to track all those various elements and cost components separately, but when analyzing that investment as an investment decision, it would be analyzed as one complete investment and could not be split into different parts. The next step is to enter the cost of the investment. There's 2 potential ways to do that. We have what we call a direct entry approach, which is a higher level approach where you generally enter, capital costs, capital offsets, O&M costs, potentially removal costs, or any other kind of major cost types that you might want to collect. Or we have a more detailed approach, which we call the cost calculator approach. And this allows you to build up the cost of the investment kind of from bottom up based on unitized pricing, as well as entering any kind of unitized offsets for that investment. Once all the costs are entered per each budget year, because you can enter multi-year investments, of course, we can move on to the common demographic section. And again, this is where you enter general information about the investment that applies across all pieces or work orders of the investment. And it's also where we capture a lot of necessary information needed for optimization, such as different work units. You can enter unitized investments, enter anywhere between, say 0 and 1,000 pieces of the investment. You can also enter different relationship types, such as dependency relationships and mutually exclusive type relationships or alternatives, as well as entering whether or not that investment is mandatory in the upcoming budget year or not. So I can enter kind of various mandatory categories. So oftentimes we absolutely recommend that you still score your mandatory investments so that you have an idea, again, of the value that those investments are still bringing to the company despite being mandatory. But this also allows you to override any kind of scoring results and automatically force that investment through when you're actually optimizing the investment portfolio. Once everything is set up within the investment description section, you can return, and what you'll see after you fill out the investment description are all applicable, what we call scoring pages, will be activated. In this particular example, you can see it's a distribution investment, so any kind of non-distribution type scoring parameters are grayed out and not applicable for that particular investment. Again, we try to make it as streamlined as possible. When we actually get into the scoring of investments, again, we score across the sub-level of strategy, which we call the success criteria level or the more detailed level. And as Jan had mentioned earlier, we score on 2 dimensions. We score on what we call a value dimension, or what will happen if you fund the investment, as well as a risk of deferral dimension, or what would happen if you were to defer the investment for 1 or more budget cycles or until that investment can be presented again for budgeting. So this is a company image example. It's a qualitative example of scoring. You can see the 2 different scores that can be calculated at the top of the sheet. And again, each scoring page is set up in kind of an inferential logic type approach where, answers to questions will unhide other applicable questions to derive those scores. So the user can simply kind of click on and read through the questions in terms of, again, what will happen if you fund the investment, what would happen if you were to defer the investment. That was a qualitative approach. We also have quantitative approaches that are used, such as SAFE or SADI or any kind of reliability impacts, where we'll actually collect numeric responses as opposed to just higher level qualitative responses. Once the user goes through the entire scoring process, he or she can submit that investment for optimization. There also can be an approval process that's implemented, and an approval step can be activated as well, whatever kind of aligns or matches to your process. There's the ability to see the scoring summary of an investment, so to see kind of all the potential pieces of information that were answered for that particular investment, and you can print that or export that as well for your records. And just like in the RIO module, we have kind of a complete set of reports where you can activate various standard reports that are saved, and you can configure these and export these, as well as a complete set of charts. So there's, again, a charting dashboard where you have kind of scoring distribution information to see, were there any kind of scoring anomalies that you might need to investigate further, potentially rescore investments, or maybe you need to, behind the scenes, tweak your scoring parameters or your weightings that have been applied. There's also the ability to look at the risk of deferral distributions to see, are you skewing towards high risk or not? And as in the case of the RIO module as well, we have risk matrices where you can see potentially where maybe your high-risk investments fall and be able to analyze them further. And again, these are all pre-optimization results before you get to the investment optimization phase. So now that we've gone through the IDS module where we've entered and scored all of our investments, we then move on to the investment optimizer or portfolio optimization phase. So I'm just going to flip over quickly. So within the investment optimizer, what we're really trying to do is, from all of the vetted and scored investments, try to determine the optimal portfolio of investments to fund in the upcoming budget cycle that either optimizes value or minimizes that risk of deferral score given various constraints applied. And again, our most common constraints are budgetary constraints, but we might also be facing resource constraints or various reliability constraints or targets that we're trying to meet in the upcoming budget year as well. So this particular module allows us to set up all of those scenarios and perform all of the applicable analysis. So the first step is loading in all of those scored investments from the IDS module. And we can kind of go through a load investments process where we can filter down the investments based on kind of various demographic parameters. Oftentimes, maybe we only want to look at a subset of years if we are allowing multi-year investments to be entered, or potentially business units. If you're scoring and analyzing investments across all business units within the company, maybe you want to limit your analysis just to one particular business unit at any given time. So once we've loaded in the investments, we have what we call the project library. This allows us to kind of view all of the demographic information, the cost information that was entered per each investment, and then all of the scoring information, both the value scoring and, again, the risk of deferral scoring that we captured within the IDS module. Likewise, we have a forced or remit column that we can manually override any of the investments that we had marked as mandatory within the IDS module. We can also, for any given scenario, mark an additional investment or more than one investment as being forced or mandatory, or we can omit them from a particular scenario. The next step is actually setting up your optimization parameters. First, we set up the optimization criteria. Do you want to optimize across all of the strategic objectives and success criteria defined in that strategic alignment module, or do we want to optimize across a subset of them? Do we want to activate various types of those forced projects, any that we had marked as forced, any maybe that would be kind of red risk or high risk of deferral, and then any of those mandatory categories that we had defined within the IDS module. And we can turn any of these on and off to be able to set up different parameters for that particular scenario. Likewise, we can set up the constraints. How many years do you want to optimize for across your investment portfolio? We can optimize up to 10 years at any time. And we can apply, again, various constraints per those years. So again, your budgetary constraints, reliability constraints. You might have various resource constraints, IT resources, design resources, et cetera. And likewise, you can apply constraints at a system level or across various business units or regions, however you want to define your parameters. The final tab is just to set up some kind of advanced optimization techniques. You can have force once started, so if you are analyzing multi-year, this can allow you to say once an investment has been optimized or started to be funded, you will continue to fund it throughout all subsequent years, and you can turn that on and off. Once you've set up all your optimization parameters, you hit Run Optimization, and the results will run. In terms of the reports that are included within this module, we have various standard reports that are included where you can quickly filter down on all of the investments. In this case, I could just simply look at all of the deferred and be able to better understand the portfolio results for that given scenario. Oftentimes, we recommend doing at least 2 baseline scenarios when we're trying to analyze our particular portfolio. One is what we call a value scenario based on optimizing on that value score, and one is a risk of deferral scenario based on optimizing on that risk of deferral score. When you compare the results of those 2 baseline scenarios, your answer most likely falls somewhere in between. And what this allows you to do is kind of weed out all of that noise. So if an investment was optimized in both scenarios, it's probably a no-brainer that that investment will be funded in your investment plan that you're putting together. If it was likewise deferred in both scenarios, then most likely that investment would not be moving forward for funding. But if it was optimized in one scenario and deferred in the other, those are the types of investments that you really want to look at more closely, have more discussions around, and then perform more sensitivity analyses around those types of investments. So maybe changing your weighting slightly that were defined in the strategic alignment module. Maybe you want to run kind of sub-analyses, making one strategic objective more important than the other, et cetera. And this allows you to make better and targeted scenarios to better make your investment planning decisions going forward. Likewise, to support this whole process and to help with communicating the results, we have an optimization dashboard in place where we have the results of the scenario, how much value was achieved, just a recap of kind of what was set in terms of parameters for that particular scenario, and then a whole dashboard of various types of reports. We have the risk of deferral charts that are included, where you can really focus on, what was high risk. That's always a question, do I have too many high-risk investments? I can hide optimized investments and see easily what was not funded and potentially double-click on that and click back. And maybe in my next scenario, I'm going to go and actually fund that particular investment. We have value charts, so how much value was achieved across all of my strategic objectives, how much value was actually left on the table in a given scenario. We also have multi-year charts if you're running multi-year analyses, as well as efficient frontier charts. So in this case, the frontier shows you the maximum value that can be achieved for every cost or dollar value, euro value, et cetera, spent. The green dot shows where that particular scenario falls on that efficient frontier line. And this dotted line shows you kind of an optimal type budget, which includes basically the point where the increase in cost starts to exceed the increase in value, plus any red risk or high risk investments that were not already included up to that point, plus any mandatory investments that weren't already included up to that point. So that's kind of maybe a minimum or optimal budget that you kind of want to target, just as a recommendation. And then in terms of really kind of focusing on answering additional questions, we have portfolio indice charts. So this is an example of a reliability measure, SAFE, for distribution or transmission, electric distribution or transmission. And we can see, are we achieving our reliability targets with this given scenario? In this case, I can see that my reliability is in fact improving. So with this scenario, I was able to potentially achieve my targets. So again, we're able to answer really important questions or frequently asked questions, such as, do I have too much mandatory? Do I have too many high risk or red risk investments? Am I meeting my reliability targets, et cetera? So this is a really effective way to also not only analyze your results, but also communicate those results to, upper management. And the final piece is being able to save a scenario. So once you save a scenario, you can actually load that scenario into what we call our scenario viewer application. And this allows anybody in the company to actually compare up to 3 scenarios side by side and compare those results. And likewise, when you save a scenario, you can also upload those results back into the IDS module so that you can track ongoing which investments have been funded or deferred for your investment planning purposes. So in conclusion, we really hope this demo of our spend optimization suite and each of these 4 linked modules has successfully illustrated how the application can help you to, first and foremost, make informed investment decisions, clearly communicate the results of your consistent, rigorous process, and ultimately turn your strategy into reality. So we're going to flip back over. I think we have one final poll question before we jump into the question and answer section. So Rachel, I'm going to pass this question over to you so you can kind of jump into the actual poll.
Okay, thank you very much. So the question is, what is the biggest hurdle in comparing actual performance achieved with what was expected from a given investment portfolio, i.e. reliability impacts, carbon footprint impacts? And the answers are from A, no hurdle, we already compare this. B, the performance management tools are not aligned to the investment portfolio structure. Or C, no connection between performance tracking, risk, and the investment portfolio. D, the interfacing of the platform/tools to make these connections. E, the data availability. Or F, not a high priority, we don't have the staff or interest to compare this. So please select your one answer and click submit. Is there a specific answer you're thinking might be more popular in this poll?
I think it certainly can vary per company to company. We know that most companies have some sort of performance management or measurement, tools or tracking tools in place. I think what we find that's most lacking is the connection of being able to see where there are performance gaps and then be able to tie that back to your risk management and investment planning processes to be able to address those performance gaps. So, we see, 25% was on the no connection between performance tracking, risk, and the investment portfolio. That's certainly expected, as well as the data availability. That's definitely expected as well. And to be honest, the reason why we introduced this question is the next phase of development for our company and for our application is the development of a performance management module where we'll be able to more effectively track and make these linkages between performance measurement and management and analysis of any kind of performance gaps and tying those back to, altering or making changes to your company strategy or the priorities of your company strategy, as well as the risks that are assigned and entered into your risk register for risk mitigation purposes. So I think now we can move probably into the question and answer section, and Rachel, I believe you'll be leading this as well.
Okay, thank you very much. Thank you to everyone who has already sent their questions in. Please continue to submit your questions. Also, just to note, if we do not have time to answer them all within this webinar, then the presenters will get back to you at a later date. So let's start with the first question. Okay, how is consistency of inputs ensured when multiple users input issues and score them against high risks?
So I can definitely take that one. So when we're actually configuring or setting up the application, we'll work with your subject matter experts to create the appropriate questions that were used for scoring in both our RIO module when we're assessing risk, as well as kind of the more detailed questions that are asked in our IDS module when we're scoring investments. And we ensure that the questions that are asked are able to be answered in the most consistent format possible. So again, we always, consistency first, then accuracy, then precision. This is a consistent comparative process that we're looking for. So we want to make sure that whatever questions are asked are able to be answered consistently, across all the different investment scorers. So we go through, again, a process with your particular subject matter experts to develop those questions, and then we also verify and validate that those questions can be answered consistently through a very rigorous sample scoring project before the application actually goes live.
Okay, thank you very much. So the second question, does your system take into consideration the PAS 55 and ISO 5500 requirements?
I will take that one, Larissa.
Okay.
So the short answer is yes. As I have hoped to show you, is that the whole tool suite is designed on the principles of establishing a line of sight in your decision-making process, and in the heart of the PAS 55 and ISO 55000, you are looking for this line of sight. Besides that, the tool suite connects risks and portfolio, creates a line of sight. There's a lot of tracking and tracing information, which always helps if you are doing a certification audit, and you can show with this tracking and tracing information what you did, who did it, when, and so we have a lot of reports to support that. So the answer would be yes, this supports a lot if you want to become PAS 55 or ISO 55000 certificated.
Okay, thank you very much. And the next question, is it possible to implement the different modules of the Spend Optimization Suite, SOS, separately?
You can take that one.
Okay, sure. Yes, absolutely it is. Although we do recommend, all modules to really support your asset management process, you can implement kind of certain combinations of the modules. If you're going to implement a subset, we recommend, obviously the SA is necessary to always have your company strategy defined and tied to the subsequent modules, but a combination of the SA and the RIO module can be implemented, as well as a combination of the SA, IDS, and IO modules for investment planning and optimization. So those are the two main combinations that could be implemented.
Okay, thank you very much. Is it possible to use the SOS for multiple disciplines or business units?
I can take that one as well. Absolutely it is. And honestly, probably the majority of our clients do use it across more than one business unit or discipline. So obviously the core businesses of any utility are the most common business units that are included. So that often includes, say, electric distribution or gas distribution, transmission, energy supply or generation. But also, in addition to that, you could have water assets that are analyzed, as well as your kind of other non-core business units such as IT, fleet, and facilities can also be included. And we have many companies who are actually scoring both risks and investments across all of these business units and being able to compare them and optimizing both within the particular business unit as well as optimizing across all of the business units. So that is certainly available.
Thank you. And is it possible to use the SOS for multiple disciplines or business units?
Yeah,
Did I just ask that one?
Yeah, we just answered that one.
Yeah, I think I did. Sorry about that. Okay, the next one.
Okay.
Why do people decide to buy such a tool suite?
I will take
that
it.
One. Sure.
Yeah. So I would say there are, of course, many reasons why people take certain decisions to buy a tool suite. But I would say in this case that when you are in the asset management domain and you struggle with more and more constraints, people that want something for you, and your portfolio is so complex. that you cannot do it with, let's say, a piece of paper to take the right decisions, and you're struggling with competing priorities, and you want to have a rigorous decision-making process, and you want to be able to run some scenarios to be sure that you present the best possible portfolio to your board, knowing that the budget will probably be less and less, and knowing that if you present one scenario, probably they will ask 3 or 4 other scenarios, and they want to have it within 2 days. In such situation, people have a need for more sophisticated tools than just having a conversation with your colleagues, because conversations with your colleagues about these decisions are okay, but if it's getting too complex due to the constraints, you need more sophisticated tools to support you. And those people who suffer from that, who feel the constraints and who feel the pressure and who see the complexity, those people would buy a tool suite like this to support them.
Okay, thank you. And how long does it take to implement the SOS application and process?
So I can field this question. It really varies per company and honestly per your time constraint or when you actually want this to be implemented. Our general recommended time frame ranges from 12 to 20 weeks depending on the number of modules and number of business units that you're implementing the application across. Again, we can do it in as little as 12 weeks, but oftentimes we'll have to modify the process a little bit where we come in with kind of our recommended scoring approaches as opposed to kind of having it be kind of a more organic process of working with your subject matter experts and being able to kind of develop those scoring approaches from the ground up. So again, general time frame is 12 to 20 weeks.
Okay. And then how are the investments linked to the added value of the business values? The risk of deferral is linked to the business risks, but how is the positive impact on business values quantified?
So I'm not. So I can take this to begin with. I'm not quite sure exactly what is being asked in the question. In terms of the positive value of the business impacts, how that's quantified or addressed, within the actual IDS module, when we're scoring investments, again, we score across all of those success criteria measures defined in the SA module, and we score on that dimension of what we call value, what will happen if you fund the investment. So we capture that in terms of both kind of risk mitigation if you were to fund the investment, as well as any other ancillary benefits that you derive from that particular investment by funding it. And then our configurable scoring approaches that we use for each success criteria measure are either qualitative. I kind of demonstrated and showed, I think, a company image example, which is more qualitative on how to derive a score of the investment based on company image, or a more quantitative or numeric approach that's often used for reliability type measures, whether it's EENS, expected energy not served, or a SAFE or SAIDI type reliability measure. So that's how we quantify the benefits that we're getting from the investments that we're funding and potentially the risk that's then being mitigated by a particular investment. Jan, I'm not sure if you have anything to add to that.
Yeah, well, I'm reading back the question. I needed some time to understand the question, but I think that what the question also addresses is how we deal with the fact that if not everything is a risk. Sometimes you also have a positive business case. I have an innovation, but not doing the innovation doesn't mean that there's a big threat. It's just a positive business case. And how would you deal with something like that? I think that this is also part of the question. And what we would do in the risk, in the RIO module, we also capture opportunities. So an opportunity is not per definition something negative, it's positive, but we would treat it as you can score the opportunity in such a way that not doing the opportunity would be a risk. So that's how you would capture an opportunity or an innovation in the RIO module. And if you look at the portfolio module, if you have a project, we would score it on 2 dimensions. One, on the positive side, what's the positive business case? So how much does this project contribute to achieving your business objectives? And second, if you don't do this project, what's the risk of deferral? If you look at the portfolio side, it's quite clear that an innovation, for example, would not have a risk of deferral, but it would have a positive business case. And in this case, it would contribute to the scenario where you optimize in the direction of adding value, but it would not have an impact on the scenario of risk of deferral. And I think this is the way how you would treat opportunities or innovations in the perspective of this tool suite. I think that this was also part of the question.
Okay, thank you very much. I think we've about run out of time now, but I know we have had a lot of other questions come in. So just to let you know that the presenters will get back to you at a later date. So that just leaves me to thank Jan and Larissa for what was a great presentation, and thanks to UMS Group for sponsoring this session. To the attendees, you will receive an email shortly telling you how you can access the on-demand version of the webinar, or you can access this through our website, which is www.business-review-webinars.com. We look forward to sharing further webinars with you, so please do keep an eye out on the website just mentioned, and follow us on Twitter at BRWebinars for daily updates, and join our LinkedIn group, Business Review Webinars. So thank you once again, and I hope you all have a lovely day.